we're talking about something I believe a lot of people sending question in is talking about the width of the wings and how wide should we use. But today we're going to focus on very tight wing iron condors, and we're going to discuss the pros and cons about using these very tight iron condors. Of course, from the title, everybody's already knew. We're going to more focus on the kind of the problems and downside of using these tight iron condors. One of the reasons iron condor becomes very popular is the flexibility of adjusting different width of the wing. So we can use $1 wide, $2 wide, all the way up to 40, 50. It really depends on the underlying price, right? For SPX, it's a $4,500 underline. You literally can push your wings to 100, 200, even wider, which is synthetically to a $10 and $20 wide in SPY. So, but right now, a lot of people, the market's a little bit uncertain about the direction, right? We're sitting at the highest interest rate about the Fed, the kind of Fed decision. It's not very clear. So a lot of people worry about what's going to happen in the next 1-2 months, or maybe before the end of the year, before the Fed has a very clear direction about the interest rate going. So that's why a lot of people asking, shall we use very tight iron condor or put a call spread to define our risk?
I like it.
Yeah. All right, so next slide. So one or two of the benefits of using the very tight iron condor, like $1 or $2 in SPY, which we can define as very, very tight, is the first, the downside protection is very small. It's very good, right? So if we use $1 wide iron condor, pretty much your largest loss is not going to be more than $70, right? It really depends on your the credit you collect. So here we have a theoretical number based on current market. So if we are able to collect 33 cents, then our buying power or the max loss is going to be 67. So your largest downside is very limited to lower than $70. If we use $2 or $3 wide, we also know our largest loss is not going to exceed $107 or $260, something around that. So this is one benefit of using very small iron condor. If you're a new trader, if you kind of really worry about your downside, using very tight iron condor definitely can protect your whatever the upper downside per unit, right? We're talking one contract.
Yep, and the reason that because extrinsic value isn't linear across the curve, right? So a lot of people look at this and say, okay, well, if I can get, I'm getting more premium per risk on the $1 wide versus the $20 wide because the amount of extrinsic value that you're getting closer at the money is going to be higher with those tighter spreads that you're putting closer at the money. When you get to 20 points wide, the move of each progressive dollar out of the money is much, much less. You're not gaining a lot of extrinsic value the further you go out on time. Why wouldn't I just do 10 or 20 of the $1 wides versus 1 or 2 of the $10 or $20 wides? And that's kind of what we're going to look at here. But it's important to understand that it's not so much about the credit that you're getting and the potential return. I mean, return on capital is a good thing, but we're going to look at kind of the other side of the coin that people miss out on because everybody's so focused on getting that super high return on capital, that super high profit potential. On paper is exactly right. And
because the only number we can get before entering trade are these theoretical numbers, right? Yes. So the assumption is if we are able to collect $33 in a $1 wide, our max loss is $67, then our max potential return to capital is over 50%. Yeah. Then this is a 45-day cycle. A lot of people then have a lot of calculation in their head. Oh, it's a 50 let's say 50% return on capital in 45 days. How many cycles do we have? We have 8 cycles in a year. So 50% return in for 8 cycles, that's a huge amount of return if you're able to achieve 100% success rate.
Yes.
That's why,
which is hard. 100% success rate is hard.
Right.
So especially with $1 wides.
Yeah.
Sorry, we keep cutting you off, but yes, the success rate, you have to consider the fact that your return on capital, yes, it's a big green number here, 54%, but your probability of max risk is also going to be your highest as well compared to a 20-point wide, which I'm sure we'll get into.
Exactly. This is what we will try to explain in the next slide. So that was actually one of the biggest reasons draw a lot of traders into those very tight iron condors, because on paper, before they can see all the results after trading for 1, 2, 3 years, they're actually very interested in that high return of capital. But that's why we always try to remind a lot of traders, return on capital or profit is not the only metrics you should looking at. Volatility, probability of profit, and the probability you can reach your max loss. All these metrics, or CVAR, all these are very important to help us to have build a very balanced position or portfolio. So in this chart is a historical performance of these iron condors and SPY. So we can see if we use $1 and $2 white iron condor, the success rate is not that attractive because of the success rate is below 65 or 67%, and we see a lot of swings in the P&L. We constantly hit the max return on capital, 50% for $1 white. But we have more number of currencies hit the max loss. So you see the max loss and max profit. Rarely you see you gain partial profit, simply because our wings is only $1 wide. For SPY, move through that $1 distance is very easy.
Yeah, it's all or nothing, right? So the trades, even though the win rates, like if you look at this, you might say to yourself, okay, I'm only giving up 10 or 11% of the winners on the $1 wide versus the 20-point wide. But what you're not accounting for is that the losers that you're realizing on the $1 and $2 wide are full losers, whereas on the 20-point wide, there's a lot of that variance outcome baked into that position. Like you might have winners that are 20 or 30 cents and losers that are 10 cents or 5 cents or 8 cents, whatever, small losers, whereas all of your losers on the $1 wide are probably 60, 70 cent losers, basically the full width of the spread. Just for context, like SPY is up $1.50 just today. So you're talking about trying to trade a spread that's could move in the money on a nothing type day like today.
Yeah, so $1.50 is about a 0.25% movement right now. But let's say 10 years ago, the SPY was only half of the price, $200. That's still only half a point of movement. It's not a huge movement for SPY. So it's very easy for the underlying just break through your short strike and all the way to the max loss. So you have a high probability to reach max loss compared to wider wings. So that's why we actually bring back to the previous point that you, Nick, you brought up about for $20 wide iron condor. A lot of people think, we probably can just replicate that trade by using 20 contract $1 wide, or let's say 16 contract of the $1 wide. We use the same buying power. We collect more premium. Our return on capital is way higher than those wide iron condors. So this chart actually shows you one of the major downside by using the tight iron condors. Even though the buying power could be the same by using more number of contracts, tight iron condor versus one contract wide iron condor, but for that $20 wide iron condor, $10 wide iron condor, the chance to hit the max loss is much, much lower than $1 wide. The reason is your break-even point is much tighter, and the distance between the short and long strikes are so close. The higher probability you're going to reach max loss.
Yeah, for the $20 wide, you need SPY to move 2 year strikes and then 20 points further out of the money. You're talking about 200-300 E-mini points, whereas the $1 wide spread, you get to your strike and now it's a 50-50 shot whether you make the full profit or you lose the full loss.
Exactly.
This slide explains why if we're going to do if we have $2,000 to risk, we're going to do the 20-point wide once rather than 20 of the $1 wides for this very reason, because we want our break-evens to be better. We want our probability of max loss to be as low as we can, and moving that wing further out of the money, where SPY really has to move in a big way for us to realize max loss, versus literally a daily expected move of 10 points in the futures before you realize max loss. That's something we want to stay away from, and this study shows
Or
that.
two of the $10 wides. I mean, like just doing less contracts, wider wings versus more contracts, tighter wings.
Yeah, so we can see from return on capital, $1 and $2, the numbers are lower than 1%. The realized is actually lower than 1%. It's not 50%. It's not 40% anymore. But look at the $5, $10, $20. If you look at 30, 40, it's very, very similar. So the return on capital is it's low, much lower, 3%. Much lower than the expected too. Like the expect return on capital of these are 20, 30, 35 or something. But 3% is kind of a start to stabilize. But when you have a very stabilized return on capital over the long term, we can kind of feel the volatility of these positions is relatively stable too. So you can have a much accurate projected return on capital over the long term rather than the $1 or $2 why the P&L fluctuate huge. So that's why some traders argue, oh, last year I traded only $1 or $2 wide on Condor. My return on capital is 40%. Yeah, it could be, right? So
the next year you could be minus 40% though. You're gonna or minus 60. Yeah, it's your swings are very, very wide, whereas the wider wings you have a tighter deviation of returns, both in your favor on the profit side and against you on the loss side. It's a much tighter, more replicable.
Yeah, you got it. Replicable.
Yeah.
You're sitting on Tom's chair?
No, I'm in Bat's chair. That's
yeah. Statistically.
Yeah.
I like it.
Can do it over longer periods of time.
All right, next slide. So we already discussed this one, right? So here we have $1, $3, $10, $20 one iron Condor. So we can see the break-even point for wire iron Condor, $10, $20 is much further away than $1 wide, right? So the green line is $1 wide, and the kind of orange pinkish is $20 wide. Although in this chart looks small, but it's actually somewhere between 262 to 268. It's kind of $5 wider. This actually can give us more kind of a probability to be for the stock to land in the profit zone. That $5 or 10% probability of profit is very important.
I like it.
Yeah. So next we're gonna. So here is a kind of the comparison between the expected return on capital we saw in the previous table and also realized return on capital. So we put these two numbers in one chart, so we can see. Yes, even we use $10 wide iron Condor, the return on capital are also much lower than the expected one, but we can see the gap between the gap becomes tighter and tighter. We also put the strangle here. The expected move and the realized, the expected return on capital and realized ones the gap are even tighter. So this means the volatility of these large iron condors is much lower, or the standard deviation of the P&L swing is much lower than the small iron condors. So that's why the small iron condors can give you really high return on capital. It also can destroy our portfolio in a very short period of time. Because let's say if you allocate 25% capital into very small iron condor in 45 days, you can either achieve 40% return on capital in that 25% of capital allocation, or you can lose that 25% off your asset value completely in 45 days.
On a much higher probability of realizing that. So like that's the variable when you think about the amount that you're losing and think about it on a probability of losing that amount, it's much higher with those tighter spreads versus the wider spread, where the probability of losing that max amount, that large amount, even though they're the same, it's a much lower probability, and so it allows you to stay in the game much longer.
Right. So that's why for kind of a new trader or a very small account trader, you can't afford to trade a very large positions. Yeah, maybe you can use a little bit tighter wing risk-defined strategies. But if you have more kind of capital in your account, you want to scale up, you probably want to start with a larger position or a riskier position per unit, then start to scale up by trading, adding more number of contracts.
Yep.
Yep. And this is why we say, 5 points wide is our minimum, and this is why. So we won't
For
sell
SPY.
for SPY. We won't sell
Or something similar.
Yeah.
Like if you're looking even in like an Apple or something like that that's trading at 170 or 180-ish, $5 wide is still my minimum. I mean, that's what I want to be at. If you're looking at $20 stock, then you can justify going tighter than that just because it's all relative to the price of the underlying. But when you're looking in the 100 to 500 range, you got to kind of be in that $5 or $10 wide spread as opposed to the $1 wide spreads that are available in some of those underlying.
Exactly.
Perfect.
Yeah. So the next one is kind of we were talking about the how fast those different width of the wings can reach to certain profit target. We always discuss we should take off our position at 50% of the max profit, or 40%, or 25% for straddle. If we use the same strangle for different width of the wings, we can see if we want to reach 50%, the wider wings actually can reach that target much faster, right? This means your return on capital efficiency is much higher for wider wing iron condor. So you can take off your position at 50% target much faster than the small iron condors. So then you can reallocate your position to the next expiration cycle or somewhere else. So that actually increase your daily return on capital efficiency.
Mm-hmm. That's a opportunity cost variable that's really hard to measure, right? So if you're able to cycle out of positions 10 days earlier, that's 10 days worth of new position extrinsic value and new opportunities that you're able to take advantage of. Maybe you have a 20-point wide in SPY and volatility in the market's relatively low, and you're able to take this off, and then some point in the next couple days after you take it off at 50%, you get a little bit of a down move and a pop in volatility, or Apple goes down 10, 15 points in a short period of time, and it allows you to have that capital available to now get into that new high volatility, high extrinsic value position. Whereas if you're still stuck in the $1 wide, now you're tested or at the money, and you don't have the capital to take advantage of a new position that has just popped up or a new opportunity that's just popped up.
And having the risk on for 30 days rather than 25, it's just more time for something to go wrong against you. Which I think is something that we don't say enough.
Over long term, actually, all these start to build up in the favor of the premium setters decide.
Mm-hmm.
I like it.
Yeah, so this is kind of a grand comparison for different width of the wings and for all the different durations, right? So this is more has more details from day one all the way to 45 days. So you can see the tight iron condor, the profit percentage actually start to drop, getting closer to the 45 days. So one argument is still we want to close our position at least 3 weeks before expiration. And second one we want to show you is the wider wings iron condors, actually the profit keeps going up. Even you can hold it longer. You don't have to, right? You don't want to, but we can see why the $1 wide iron condor, the volatility start to kick in, especially in the last 2 or 3 weeks for tight iron condor. So you can see that volatility start to eat up your profitability you build up in the first 3 or 4 weeks.
Mm-hmm. Yeah, that makes sense because it becomes even more binary. As you get closer to expiration, the outcomes are either all or nothing, and that's why the volatility gets so great in that last 30 days to basically after 30 days, you see that this chart, depending on what time frame you're looking at, is probably going to spike up to the top or spike up to the downside on a low number of occurrences because the outcomes are just are binary, whereas the 5, 10, and strangle, they're a little bit more flat. So
if you're able to look into those data, you can see in the last couple of days for very tight iron condors, if the underlying price is very close to the short strike, you can see return on capital is jumping in between 5 positive 20%, negative 80%, positive 25, negative 95 if they cross that $1 wide wing.
Yeah.
So your P&L vault is huge. But if you use wider on Condor, your percentage of profit is going to jump between 15, 16, 20, 14, 25. So the range is actually much tighter than those small iron condors.
Yep.
Yeah, so we pretty much already went through all these key points. Definitely, there on paper, there's some benefits of using very small iron condors. If you have very small account, if $5,000, you probably want to start with $2 or $3 wide iron condor. That's fine. But when you have more confidence, you have more capital to trade. Definitely try to widen out your wings.
Yep. Beautiful. Wider wings versus more contracts makes the trade overall a better statistical trade at the very least.
Yep.
For sure.
Good stuff, Kai. Thank you for coming on to present
Thank you for having me.
That's a good one for everybody to watch. Hope you enjoyed that. We're going to take a quick little 90-second break. We're going to come back with, oh joy, big boy Scotty S. for live from the Tasty Trade Desk. You want to give us a call, we'll take phone calls afterwards as well. 855-238-2789 or 855-BE-TASTY. We're going to take a quick little 90-second break. You're listening to Tasty Live.